Meet Margaret. She is 67. She spent 40 years working, saving, doing everything right. She never carried credit card debt. She never gambled on stocks. She put money away every single month into a savings account because that is what responsible people do. Today, her savings buy roughly half of what they bought when she started. Nobody robbed her. No market crashed. No scandal made the news. The system just worked exactly as designed. Every government in the world tells you inflation is the enemy. They form committees to fight it. They raise interest rates. They give speeches about protecting your purchasing power. They act like inflation is this rogue force they are constantly battling on your behalf. But here is what they never say out loud. They need it. Quietly, desperately, structurally. They need inflation to survive, and Margaret paid for it without ever knowing she was the one writing the check. Once you see how the math works, you cannot unsee it. The United States currently carries over $33 trillion in national debt. The UK, Japan, and France are all running debt loads that would make any private business look criminally irresponsible. These are not temporary wartime emergencies. This is the permanent operating condition of every modern government on Earth. Now here is the question nobody asks clearly enough. How does a government pay back debt that large? The honest answer is, it mostly does not. Not in the way you or I would pay back a loan. Instead, it does something far more elegant, far more invisible. It inflates its way out. Here is how it works, and it is almost embarrassingly simple once you see it. A government borrows $1 trillion today. That debt is fixed. The number on paper stays the same for the life of the bond, 10, 20, 30 years. But the value of the dollar it borrowed in? That shrinks every single year inflation runs. At just 3% annual inflation, $1 trillion borrowed today is worth roughly $740 billion in real terms 20 years from now. The government pays back the full number, the full $1 trillion, but the actual burden, the real economic weight of that debt, quietly dissolved while nobody was watching. It did not vanish. It transferred. To Margaret. To anyone holding cash. To anyone on a fixed income. To anyone whose salary did not keep pace. The government's debt got lighter because their purchasing power got heavier to carry. That is not a side effect. That is the mechanism. Now layer in something else. Governments do not borrow once and stop. They borrow continuously, rolling old debt into new debt, running deficits in good years and bad years, expanding spending faster than tax revenue in almost every developed economy since the 1970s. To keep this entire structure from collapsing, they need two things running simultaneously. GDP growth, so the debt looks manageable as a percentage of the economy, and inflation, so the real value of what they owe keeps quiet. Lie eroding year after year. The technical term is debt monetization, but the practical reality is simpler. A government with a central bank and its own currency can never truly run out of money. What it can do is slowly dilute the value of every dollar already in existence. And that dilution has a friendlier name. They call it monetary policy. Here is where it gets genuinely uncomfortable. When a central bank sets an inflation target, 2% in most developed economies, it is not setting a ceiling, it is setting a floor, a quiet guarantee to bond markets that the currency will not strengthen, a reliable signal that the real value of government debt will be gently, continuously, and structurally eroded. 2% sounds responsible, it sounds almost cautious. But compounded over 30 years, 2% annual inflation cuts the purchasing power of a dollar nearly in half. They are not fighting inflation, they are managing it, aiming at it. There is a profound difference between those two things, and most people never notice it. The absurdity sharpens when you look at what happens the moment inflation disappears entirely. When prices fall, which sounds like it should help ordinary people, governments and central banks do not celebrate, they panic. Deflation means debt becomes heavier in real terms. Every dollar owed tomorrow is worth more than the dollar borrowed yesterday. The entire machinery runs in reverse, and the weight of accumulated debt becomes crushing. Japan spent 30 years trapped in exactly this. The government's response was not relief, it was alarm. Decades of aggressive stimulus, money creation, and near zero interest rates, all desperately engineered to generate the very inflation they publicly claimed to despise. The mask slipped, and they barely noticed. So the next time a finance minister stands at a podium and solemnly declares war on rising prices, listen carefully to what they are actually promising. They will show you charts. They will raise rates until something in the economy visibly breaks. They will bring inflation down to a level that still quietly erodes debt, year after year, and then they will declare victory and move on. The target is never zero. It never was. Zero would be catastrophic for them. And somewhere inside the machinery of every modern economy is this unspoken agreement that the currency you save in today will buy slightly less tomorrow, and that this slow, invisible, perfectly calibrated erosion is not a flaw accidentally built into the system. It is the load-bearing wall holding the whole structure up. Margaret did not know she was funding that wall. She just thought she was saving for retirement, which leaves one question worth sitting with long after this video ends. If inflation is structurally necessary for governments to survive their own debts, and if the people who save responsibly quietly absorb the cost, then the real question was never whether inflation is good or bad. The real question is, who decided that Margaret should be the one to pay for it? And why nobody ever asked her?